even though you had counted on that to help you manage your risk exposure. So the net effect of this was we had a massive amount of new money flowing into the housing sector. We also had the emergence of housing speculators who were buying and selling properties on the expectation that the housing market would keep going up and up and up. Unfortunately, a number of factors around 2007 contributed to the bursting of that particular bubble. There was significant oversupply of housing. The interest rates went up as the Fed began tightening money policy. And the result of that was that, particularly with respect to adjustable rate mortgages, what began happening was a phenomenon in which the borrower would see their adjustable rate mortgage reset to a much higher interest rate, which raised their monthly mortgage payments, in some cases, fairly significantly. Now, for many borrowers, particularly subprime borrowers, people in lower income categories who basically were living check to check and had gotten into buying a house because they had gotten an ARM, an adjustable rate mortgage, with teaser rates, very low finance rates, and the like, what began happening was that they were unable to make the payments on the mortgages they came due. Another problem was that a lot of subprime borrowers had gotten mortgages that had balloon rates or balloon payments. And so, for example, you would basically have 5 years of very low payments, at which point there would be a big balloon payment that you would be required to make. The expectation and what these borrowers were told when they bought these mortgages was, look, you'll be able to refinance it. When the balloon payment comes due, you'll be able to go into the market, get another mortgage, and just refinance it. You'll never have to make this payment. Well, the problem was that in the tight money environment of 2007, a lot of these borrowers found that they were not able to refinance those mortgages. The net effect of all this was a significant increase in the default rate, and as defaults increased, home prices began to drop. As home prices continued to drop, more and more borrowers went underwater, in which their house was worth less than what they owed on it, which made it difficult for them to refinance. And there was this whole sort of vicious death spiral, if you will, in which there was a massive increase in the amount of foreclosures and defaults taking place. This led, of course, inevitably, to a decline in the value of the securities, the mortgage-backed securities that have been issued with respect to these mortgages. These mortgage-backed securities declined rather dramatically in value. They also saw the rating agencies chop their credit rating. And the net effect of this was that banks holding mortgage-backed securities were forced to mark down the value of those securities using what's known as mark-to-market accounting rules. This got the banks into a position in which the banks began to find it difficult to raise capital and were having to sell assets into a distressed market. Now, this had an effect on both Wall Street and on Main Street. The impact on Wall Street was a flight to quality rather, and a liquidity crunch. Investors became unwilling to lend to banks, particularly banks that were large and had significant mortgage exposures. They fled into higher quality securities such as treasuries and so on. And the like. In addition, there was considerable concern about the creditworthiness of these banks and other counterparties, a process that began to accelerate when Bear Stearns went down in early 2008. There was a simultaneous impact on Wall Street, or on Main Street rather, as more and more of these banks began to tank. And let's just take a minute to review sort of the process that we went through in 2008 and early 2009. The sort of opening gun was the failure of Bear Stearns, and the government came in and facilitated an acquisition of Bear Stearns by J.P. Morgan Chase. The next shoe to drop was the financial troubles at Fannie Mae and Freddie Mac. Now, Fannie Mae and Freddie Mac were, in theory, not government agencies. In theory, they were private agencies, and their job was to facilitate the mortgage market. Basically, what they would do would be to buy mortgages from banks. And then, of course, once the securitization process began, they would begin issuing mortgage-backed securities. But going back into the 30s, they had been, Fannie and then later Freddie, had been around basically to act as a factor, if you will, by purchasing mortgages from the banks, which gives the banks money that they can then lend again. And basically the idea was that this would act as a way of encouraging capital and encouraging banks to make mortgages. In, I think, the 1960s, these quasi-government bodies were in theory privatized. In theory, they became stock corporations that would rise and stand on their own. The problem was nobody believed that. Right? Everybody knew that if push came to shove, the taxpayer would be on the hook for Fannie and Freddie's obligations. This meant that Fannie and Freddie were able to borrow at favorable rates. It meant that they were able to avoid close scrutiny of a lot of their corporate governance practices, and so on. And then when they got into financial trouble, we in fact saw that the taxpayer was indeed on the hook. The government was unwilling to let Fannie and Freddie fail. They were unwilling to let them go through bankruptcy. And they were sort of the first too big to fail event. What happened next contributed massively to the problem by generating enormous amounts of uncertainty, because what happened next was Lehman Brothers fails, and in the closing days of the Bush administration, the Bush administration makes the decision not to bail out Lehman Brothers. And there's a lot of talk about moral hazard, right? And the like, that, we can't have an environment in which these banks are too big to fail, because basically it means the taxpayer would be on the hook. That would encourage risky investment activity that would make it more likely that the bank would fail, which would make it more likely that the taxpayer would have to step in, and so on. And so the Bush administration said, we're going to let Lehman fail. Well, that had two immediate consequences, the first of which was there was now enormous amounts of uncertainty. To what extent would the government backstop the financial sector as the financial sector was getting into more and more and deeper trouble? Now, all of a sudden, there were questions about, okay, what's the government going to do here? And this is particularly complicated by the fact that we're in the middle of a presidential election, right? And this is immediate fodder for the presidential politics. You'll remember the famous meeting at the White House where McCain and Obama meet with Bush in theory to sort out a bipartisan approach, only to degenerate into rather vicious arguments, and Bush basically walking out of the room. In the market, the effect of Lehman Brothers was to immediately create a problem for AIG. Lehman Brothers had been a major retailer of credit default swaps, and all of Lehman's counterparties, which have these credit default swaps, are now worried because, okay,